studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that sunky died.
One of the most common Schedule 1 adjustments is the add-back for the corporation's income tax provision. This adjustment often confuses beginners because the income tax expense appears on the financial statements, but it is not deductible for income tax purposes. Let's start with the accounting treatment. At the end of the year, a corporation estimates the income taxes it owes for the current year. This estimated amount is recorded as an income tax expense on the income statement. Recording this expense follows accounting standards and helps present an accurate picture of the company's financial performance. For example, suppose a corporation reports income before tax of $100,000 and records an income tax expense of $12,000. The accounting net income after tax becomes $88,000. From an accounting perspective, this is completely correct. However, the tax treatment is different. When calculating taxable income, the corporation is not allowed to deduct its own income tax expense. In other words, the cost of paying corporate income tax cannot itself reduce the income on which tax is calculated. Therefore, the entire income tax provision of $12,000 must be added back on Schedule 1. Notice what happens. The accounting records reduce profit by $12,000 because of the income tax expense. Schedule 1 then reverses that reduction by adding back the full $12,000. As a result, the corporation's taxable income is calculated before deducting corporate income taxes. A simple way to remember this rule is that income tax is the result of calculating taxable income, not an expense used to calculate taxable income. So whenever you review a corporation's income statement and see an account called income tax expense, current tax expense, or provision for income taxes, your first thought should be that this amount is generally not deductible for tax purposes. The accounting entry remains in the financial statements, but for tax purposes, the full amount is added back on Schedule 1 before the corporation's actual tax liability is calculated. This ensures that taxable income is determined correctly under the Income Tax Act. At first, the rule that income tax must be added back may seem confusing. After all, if the corporation actually pays income tax, why can't it simply deduct that expense like any other business cost? The answer becomes clear once we understand how taxable income is calculated. Let's begin with a simple example. Suppose a corporation earns $500,000 in profit before tax. Following accounting standards, the company estimates its income tax expense and records it on the income statement. This reduces the accounting net income reported in the financial statements. Now imagine what would happen if the corporation were allowed to deduct that income tax expense when calculating taxable income. The tax expense would reduce taxable income. A lower taxable income would produce a lower tax expense. That lower tax expense would then reduce taxable income even further. This process would continue over and over again, creating an endless circular calculation. In other words, the tax would keep reducing itself. To prevent this circular problem, the Income Tax Act follows a simple principle. The corporation first calculates its taxable income before deducting its own income tax expense. Only after taxable income has been determined is the corporation's actual income tax calculated. This is why Schedule 1 requires the income tax provision to be added back. The adjustment removes the accounting tax expense from the calculation so that taxable income can be determined correctly. A helpful way to remember this concept is that income tax is the result of taxable income, not an expense used to calculate taxable income. Think of it as a two-step process. First, determine the corporation's taxable income. Second, Calculate the income tax payable based on that taxable income. Never reverse the order. Once you understand this logic, the Schedule 1 adjustment becomes very easy to remember. The income tax expense remains on the financial statements for accounting purposes, but for tax purposes, it is always removed by adding it back before calculating the corporation's tax liability. Before filing a T2 corporate tax return, it's important to review the corporation's income tax provision carefully. This is one of the most common Schedule 1 adjustments, and fortunately, it's also one of the easiest to identify once you know what to look for. Start by reviewing the corporation's financial statements. On the income statement, look for accounts with names such as income tax expense, current tax expense, provision for income taxes, corporate income tax, or simply tax provision. When you find one of these accounts, ask yourself a few simple questions. First, is this expense related to the corporation's own income taxes? If the answer is yes, the next question is whether it represents an accounting provision recorded under accounting standards. In most cases, the answer will also be yes. Once you've confirmed that it is an accounting provision for corporate income tax, the tax treatment is straightforward. The entire amount is generally added back on Schedule 1 because a corporation cannot deduct its own income tax expense when calculating taxable income. If you're using professional tax software, this adjustment may be generated automatically. Even so, it's still your responsibility to verify that the amount has been identified correctly and that the software has applied the adjustment properly. As you review the financial statements, pay particular attention to common account names that indicate an income tax provision. These include current tax expense, deferred tax expense, tax provision, corporate tax accrual, and year-end provision entries. These accounts should always prompt you to consider whether a Schedule 1 add-back is required. A good habit is to never assume that every tax-related account is deductible. Instead, determine whether the expense represents the corporation's own income tax liability. If it does, it generally belongs on the add-back list. The rule is easy to remember. The income tax expense remains in the accounting records because it is required for financial reporting. But for tax purposes, it is never deducted when calculating taxable income. Instead, 100% of the income tax provision is added back on Schedule 1 before the corporation's actual tax liability is calculated. Following this simple review process will help you prepare accurate T2 returns and avoid one of the most common Schedule 1 errors.